Howdy there, folks. Welcome into today's video. Thanks for joining me. 24,100 plus subscribers now on this channel. I appreciate y'all. We got a 2-for-1 here today. Buy one, get one free. First video up to react to. Jerome Powell's testimony could lay the groundwork for a sell-off in tech, says Gene Munster. We'll hear what he has to say in regards to an upcoming sell-off in tech stocks, which I do hope comes, and we'll hear about that, okay? Then we're going to hear a little bit of talk from Fundstrat gentlemen, talking about Apple stock as well as many other things in the market in this clip as well. And I thought this would be a good one to react to since it covers several different subjects here, and I can kind of share my perspective and my opinion on that. And once again, thank you everybody that subscribed to the channel. Also, just so you guys know, I recorded you a 30-minute workshop last night that if you're somebody that wants to scale to 6 figures plus in your portfolio, that video should help you out tremendously. It's a free video. It'll be the pinned comment down there. It'll also be linked in the description. And basically, we'll send it over to your email or you text you it if you want it via text, either way. And basically, it's just a video that kind of goes into my steps in the process on how you can achieve 6 figures and do it actually much more rapidly than I think a lot of folks assume. And so I think you should just get good value out of that video there, okay? All right, let's get in this.
For moves in the tech sector tomorrow and Wednesday when Fed Chair Jay Powell goes before Congress to testify on monetary policy. Joining us right now for more on all of this is Gene Munster, the managing partner at Deepwater Asset Management. Gene, what do you think if Jay Powell starts talking tougher about inflation, maybe tougher than he did last time around? Is that going to be a problem for the high-growth tech stocks?
Becky, I think undoubtedly it will be, and I think that should be the positioning of tech investors going into Powell's testimony on Tuesday and Wednesday. The reason is I'm going to take what he said at the Washington think tank a few weeks ago as true when he said he does not get this economic data beforehand. Sometimes he gets a few hours heads up. The next key data point, of course, is Friday with the jobs number. Therefore, for the next couple days, or at least with his testimony, I suspect Chairman Powell is going to retreat to his fallback position of a more hawkish tone. I think what he learned with the last Fed meeting is that if he is not overly hawkish, the market tends to interpret any fractional positive news related to any sort of breaks coming up in interest rates. And so I suspect that he's going to be pretty hawkish, and I suspect that that's going to kind of lay the groundwork for a sell-off in tech. I'm a big believer in tech. I think this first half of the year is going to be a difficult year for tech, and it's a very simple equation related to what we're seeing in the economy and specifically related to inflation. We'll hear that from Powell this week.
All right, here's a huge problem that Gene Munster should bring up, in my personal opinion, okay? And this is a different way to look at this. He's just acting like, you know, Jay Powell's going to have to be super hawkish and all these sorts of things, okay? What he's not taking into account is the fact that many of the Dems definitely are going to try to put him into a situation where maybe he even gets a bit dovish on, you know, when he's asked questions, essentially. And the thing is, like, Dems definitely, they're worried about potentially causing a recession. Because here's the deal. We know if a recession does come, let's say a recession comes at the end of this year going into 2024, guess what happens in 2024? There's a presidential election, right? Other elections as well, but presidential election. And I can tell you, if you're in a recession when a presidential election is about to happen, it's not going to bode well for you. It's usually you're out of office, okay? And so, nonetheless, I think Dems understand what's up for grabs here, and they're afraid Powell's going to push too far. He's going to cause a big recession, and ultimately they'll lose the White House in this situation. Now, it's possible they could lose the White House regardless in 24, obviously, in that election. But I can tell you their chances of winning are hurt substantially if we're in some sort of situation where there's a lot of jobs being lost at that particular time. And that's what they're afraid of. And so that's why Powell has to walk this fine line where he's going to have to talk out of both sides of his mouth, as they say, and he's going to have to talk. He's going to have to, have hawkish talk. He's going to have dovish talk. He's going to have to try to please everybody. It's not going to be possible. That's why the market will likely be volatile this week. You'll see some big upward and downward moves, but it's a very very difficult thing. And so if you think he's just going to talk one way, I think you don't know what he's in for in the situation, which is a very very tough situation for him. I'm glad I'm not in his position. He's about to be grilled across the board.
If that's what you're doing short term, longer term, do you go back into those stocks, like just get out of them in a trading sort of way ahead of that testimony?
So I think there are two approaches. We have two different products for each approach, but one approach is to time the market. I think if you have a market timing perspective, it's best to have an overly weighted cash position right now. That fund, we're just over 50% in cash. It is. I do not sleep well at night if the market and fears of the market ripping, but that is our perspective, at least for the next several months, as we think that there's going to be some softness. And we're still invested, though. Half we're still invested in companies that we think have margin upside. We do think that this sets up, and I don't want to split hairs and have a mixed message here. I want to be very clear. First half, I think that these stocks are going to be less performing relative to the overall market. But I think the back half of 23 and into 24 is going to be a great year for tech. I think that the numbers have come down now. We've seen more modest growth rates so that you just have easier comps, which sets up for, I think, a good investing period for tech. So near term, more cautious. But I still think if investors believe and want to be fully invested, there's still great companies to be invested in.
I love what he just said there. Did you hear what that man just said? He just said his timing the market fund, or whatever product he has there, is 50% cash right now. 50%. I love how many people are in cash and treasuries right now. It's an immense amount of money, okay? Everybody's scared about what the market could do. It goes down, whatever. Obviously, you have a lot of people that are just getting great returns in treasuries right now, or CD accounts, savings accounts, whatever. And so there's just an overwhelming amount of just kind of cash on the sideline right now that's just like, I don't want to be in the market. I'm just getting my return over here. I'm concerned. I'm worried, these sorts of things. And I just love that, man. I love that. A market that scares me is a market in which we don't see that. It's a market when everybody's all in, because at some point in time, if everybody seems like they're all in the market, what do you have left for upside at that point in time? Seriously, like if almost everybody you hear and talking is like they're fully invested, you can't even, it's literally not possible to move up anymore at that point in time. You're in just a horrible position in the market for, the next 6, 12, 18, 24 months, whatever that position is, right? And if we go back to the end of 2021, most market participants were, a lot of them were heavily invested in the market, and look what obviously happened after that period of time. It was many various factors, but that's something to think about there, okay? All right, next video up here. Talk about a bunch of different subjects, including Apple in this one, and kind of share my perspective on this one.
Adam Parker of Trivariate Research, see what he makes of what Mr. Krinsky just said. It's good to have you back.
Thanks for having me.
You're not really a believer in the move higher that we've had in stocks anyway, right?
Well, I mean, I think the data points that we're looking at, from rates to speculation to valuation to earnings expectations, all look worse than they did 3 months ago. I mean, with Apple, I don't know enough about two-day technicals to dispute what he said, so I'll go with it.
But I mean, it's the biggest stock in the market having what looked to be some kind of breakout is not insignificant to you, though.
No, I just think it's the market ripped in the Q4 up 5-6%, and this thing was down, right? And now it's up a ton, and now it caught an upgrade from a big firm. So, sure.
Wait a minute. Hold on. Oh, this is so embarrassing. I'm so embarrassed for myself. I think at the beginning of this video, I had said that this man was from Fundstrat. Didn't I? I'm going to have to rewind the video. I think I said he's from Fundstrat. It's fundamentals, okay? I'm just so used to reacting to Fundstrat people that I automatically assume everybody works for Fundstrat. I do apologize about that. Oh gosh.
Hey, but I don't think that means it's in better position. I mean, I looked at Apple a lot lately, actually, and one thing that really surprised me is in the last 10 years, their net income has only grown 9% a year. Right? If you told me 10 years ago it was going to grow 9% a year, I'm not even sure you and I would have sat here and said it was a growth stock. Now, they bought back 40% of their shares, and so it's been a monster. But, I don't know, looking out forward to me in a longer-term view, I don't know how I could like that versus like the energy sector, which is the same size. So, it depends on your horizon and what you're really trying to accomplish when you invest. But it doesn't make sense to me.
How do you size up what's at stake over the next, as we say, 13 trading days? You got Powell tomorrow on the Hill, and all eyes are on that. And maybe the fact that yields turned around today to move higher, maybe trying to get ahead of what could be more hawkish testimony from Chair Powell tomorrow. But then you got the jobs report, you got CPI, you got ECB, you got Fed decision. 13 critical days.
Yeah, I just think the risk reward, I mean, look, what we wrote in our note you saw this week was, what is the bull case? If I show up today and I think we're going to end the year 10% higher in the S&P and I want to really deploy some fresh capital at sort of 40, 50 round numbers, I got to believe in something close to 4,500. Say at year end, what do I need to believe? Like, what is that bull case? I need sort of slowly declining inflation. I need the Fed to get less hawkish, but pause and not ever, data get worse where they're going to cut. I need, sort of input costs to come down so the companies can expand. I mean, there's a lot of if I need sentiment and positioning to then therefore think things are going to be a lot better in 2024. It just feels like the risk reward skewed to the negative to walk in today and get very, very excited, just given how much worse the data looked than 3 months ago.
I mean,
So there's a lot of potentials for the bull case. The bull case could look like a situation where the Fed stops raising rates, let's call it in the next 3 to 6 months, and potentially starts cutting rates at the back half of this year if inflation comes way down and everybody starts to become convinced that inflation is going to stay in the 2 to 3% range. That's a situation that obviously, then treasury yields are going to come down. If you're talking about any savings products and things like that, all of a sudden those yields come down and all of a sudden you got to put money back into work in the market, right? And imagine a scenario where you don't see a huge tick up in unemployment. Unemployment stays in the 3.5 to 4% range, which is historically very, very low, right? While earnings strengthen as the year goes along. Boom, there's your bull case right there. And you're talking about S&P up to 4,400, 4,500 at the end of the year if in that bull case scenario, if that was to play out, right? The bear case scenario, you need a lot of things to work out there, right? You need unemployment to tick up in a massive way, people to lose jobs. You need inflation to stay. There it is. It never fails. Monster choppers, never living in flipping flapjack in Afghanistan over here. Never flipping flapjack and fails, man. Oh, gosh, those dang choppers drive me crazy. I'm trying to record a video here, man. You guys are flying around like it's Grand Theft Auto over here. Holy smokes. So, for the bear case, once again, to get back into the bear case, you need inflation to stay high, you need the Fed to keep raising, you need unemployment to tick up massively, right? Huge job losses there, earnings to continue to just get worse and worse and worse for the largest companies in the world, right? And that could be a scenario, obviously, the market goes down substantially, but you need a lot of things to kind of play out there. And so that's why both sides ultimately are having trouble. That's why we're having trouble moving this market in any substantial way now at this point in time, because you need a lot to happen on both sides of this game now at this point in time. And it starts to become like, okay, both sides need it. If bears are delusional if they think, the bull case can't play out. And bulls are delusional if they think the bear case can't play out. Both could play out in this situation, and we all have to take that into perspective right now. And that's why the market's having trouble. You're seeing this market flounder anywhere between 3,800 and 4,200 right now when it comes to S&P. Because at the end of the day, the bull case hasn't played out. We need to get more confirmation to put this market up more. And why can't we go down 3,600, 3,200 right now? We need a lot more in the bear case to play out. That's why we're just in a range.
And soon, inflation down faster than people think, earnings not as bad as feared. So that's that hard to put that story together, you
think? I think it is. If the Fed's going to get dovish, I think that's going to happen because the economy and earnings are really going down.
What if they don't get dovish? They just get dunnish.
Yeah, I mean, so that's what people want. We had 20-something meetings, a couple dinners with investors last week. Every meeting I said, what do you think the bull case is? It was tough. The Fed getting out of the way. So I said, well, what does that mean? What does them getting out of the way mean? I think that means you think they're pausing for a long time because we're in this Goldilocks zone of data on inflation and jobs. I mean, anything's possible, but that certainly isn't the highest probability outcome. I think the highest probability outcome is they stay hawkish until they can handle the services and wages part of the economy and get inflation much lower.
You still think the macro gets worse as we progress, like Marko Kolanovic at JP Morgan is talking about, right? He's one of those who was trying to be pretty bullish last year in the face of a lot of negativity. Then, as I've been saying, kind of saw the writing on the wall. And now he expects the macro to deteriorate. Wrote today, one strong day or weakened risk does not change our negative outlook that is predicated on weakening macro fundamentals.
I think we've had the same view on the macro part for 9 months. Erode, not implode, but not sure 24 earnings will be above 2023. So one of the reasons I got more worried a couple weeks ago is I think the 24 numbers are out and they're 11.5% earnings growth expectations. So now I know I'm going to have meaningful downward revisions in the second half of the year because I don't see a big, fiscal stimulus incremental or big, accommodative money.
Newell Brands down at, what was that, $12? I might have to take a peek. They used to be a really good dividend stock there. Newell Brands? Where was that at? I think it was right.
And they're 11.5% earnings growth expectations. So now I know I'm going to have meaningful downward revisions in the second half of the year because I don't see a...
Yeah, Newell Brands, $13. I might have to take a peek, see if there's something there. Interesting. Very interesting.
Big, fiscal stimulus incremental or big, accommodative monetary policy. So I need earnings to really do well. I think things are okay. I still think I can find things that are going to outperform in an eroding backdrop. But I don't see how somebody could sit here today and say the probability the economy improves is better than higher than the probability it deteriorates.
No, but does it?
It could improve tremendously from here. Let's not forget, the only thing we really have had going for us as far as the economy for the last, let's call it, 6-9 months is low unemployment. But outside of that, you haven't had, look at company earnings. Have company earnings been great? No. Company earnings are going to tell you how strong or not strong the economy really is at a particular time. And so the economy's kind of been acting a little recessionary, just we haven't had unemployment tick up because at the end of the day, these companies need workers. And so you haven't really seen any movement when it comes to unemployment rate. But the bottom line is it's not like necessarily people have been feeling the economy's booming. Look at new home sales. Look at those numbers the past 6-9 months. Tell me that's a booming economy. So the fact is the economy could get far better from here. And it has really nothing to do with unemployment. It just has a lot more to do with confidence and people having more money to spend and do stuff, right? That's the bottom line with that. So, just because you have low unemployment does not mean the economy is necessarily booming at a particular time. It goes deeper.
No one's going to come out and necessarily say it's going to improve. But I feel like the base case has become, okay, well, we could get a soft recession. I mean... Yeah, you don't have to have the whole thing.
I got a soft recession.
No, there's some years in the past that I thought we had a great economy and unemployment was way higher, dramatically higher than right now. I think 2012, 2013, 2014 were really good years for the economy, and yet unemployment didn't really show it, right? I thought 2017, 18, 19 were really, really good years in the economy, right? And so, there can be sometimes some years that are really good economically, but maybe just aren't showing up as far as some of the numbers go, like an unemployment rate, for instance.
What if it just doesn't get any worse?
I think the part that's the least compelling, I hear you, right? I mean, I think the part that's least compelling is simply I can buy, after tax on a, whatever duration I want, 6 months to 2 years, something that yields close to 4.5, after tax maybe, so that's tax. Guaranteed, equities don't look that compelling unless I really believe either the multiples are going to expand a ton or earnings are going to surprise to the upside. So I'm not in the camp that earnings surprise to the upside. So now we're talking about the multiple. That's a bit of a gamble, and that comes down to perceptions about the Fed. So you need to believe that, it's that simple. It's got to be earnings or the multiple.
But that's still the biggest problem for equities and for stock investors, that the bond market is just too much an attractive alternative?
I think so, and I think for a lot of people, it's the first time in their investing lifetime. And I know for me,
money markets too.
Yeah, we talked about in the year last May. I mean, that's when chuckleheads like me started laddering treasuries for the first time in our investment careers. I used to have CDs, now I have a whole treasury schedule.
I know,
right?
but
so it's compelling.
It doesn't give you pause that sort of everybody is on the same side of the boat at this point. As you said at the very top, you go talk to people.
That's the biggest bull case, is that
parties.
Every top-down guy's got a maximum 4,200. That's definitely the biggest bull case. But just because everyone knows I'm ugly doesn't make me handsome. I mean, sometimes it is what it is. Like the earnings expectations are high, the rates are up a ton, perception about rates are up a ton. The valuation went from below 15 times in October to 18 and change times now. Speculation's rampant. We got a lot of stuff up a ton from lows. So the only thing that really could be outside still is a little bit of positioning, and that's tough to play for that, dream that I guess I buy my little dream today, I sell it to a sucker with a bigger dream later, and that's getting harder.
Well, when do you know that it's time to play for the other side of what we're in? At some point, you do.
I think that's right. I think you've got to believe that earnings or margins can surprise to the upside, or that the balance sheet repair can be massive. One of the reasons I really like energy, we've been hammering on metals, is because inventory is low, expectations are low, and they're pretty cheap. So I think that's pretty good risk reward. I'm just more worried about areas that everyone loves the stocks. There's a big inventory problem, and or I need to believe the economy accelerates. So I still don't
What
think
do you
you
mean,
want to
like
buy
retail, like discretionary, which has led year to date?
It has, because it got, crushed last year, and Q4 was probably...
And the consumer's been holding in.
And the consumer's holding in at the low end, but I think a lot of those stocks that miss, one of the things that's interesting about retailers in particular, even the ones that trade at 7 times earnings, when they miss, the stocks go down a lot. So I don't have that. You know what you want? You want stocks to miss and not go down. Then you say, okay, now the bad news is in the price, and somehow they show some better progress. So I haven't seen stocks that are cheap miss and hold in.
Well, we've
in consumer.
I'm not okay in consumer.
Yeah.
I'm glad you make the distinction, because we have had some stocks that initially went down on earnings and then turned around,
like Apple.
But that's a positive sign that you want to look for.
I think yes, I'd say that's right, particularly with cyclicals or businesses where you're trying to gauge the inventory. But some of these large ones like Apple, which I'd say 80% of its returns are explained by macro factors and flows, it's not really people's view of the fundamentals are way better. I mean, I don't know how somebody could argue that, it's worth whatever the analyst said, 30% more. So they're saying $750 billion, that thing's worth more. I don't know, man. There's a lot of other things that, that's a lot to wood to chop. So
you don't think that the fundamentals of an Apple are better than the fundamentals of an industrial, for example, in what is likely to be a slower economy?
I think it really depends.
You had to bet on one versus the other?
If you're bearish, I guess you're making a relative call on the estimate achievability in a 6-month view. It depends. If you're an oil and gas exposed, if you're an agricultural exposed, some industrials are going to be pretty good. I mean, I think it just depends on the end market. I just struggle with what's the long-term story there. I'm not saying, the jig is up, but, obviously, if I can look at the cash flows and look at the businesses, I can own the energy sector 5% of the S&P. I can own Apple at 5%. I'm taking the energy sector every day of the week and twice on Sunday.
So you take a cat or a deer over an Apple?
Those have other businesses besides just oil and gas, but I'll take. Well,
because you said ag. That's what made.
Well, I think end market's good. I'm saying some of the industrials have end market. Yeah, I could be right.
What about why isn't energy working?
I think the last 3 Wednesday prints from the government data look a little high on inventory, so people were worried about that. I would have thought a possible catalyst could be China's GDP guidance over the weekend. It didn't really come up to be an upside surprise, so that was one of the things that maybe could have gotten us a little bit more positive. If you're looking for bull cases, it could have been, evidence that they're going to manage the economy to a higher recovery than people thought. They kind of put a little bit of water on that fire over the weekend. So I thought
they brought out a good point in regards to Apple there. And obviously I don't own an Apple stock. I do own several companies that sell semiconductors to Apple. But let's say Apple's trading at a 22 forward P, for instance, right? Would you rather own that, or would you rather own Coca-Cola at a 22 forward P, or Pepsi at 22 forward P, or Procter & Gamble at 20? And I don't know if those are trading at 22 forward Ps. I'm just saying, imagine they're all similar, right? What would you rather hold? Would you rather hold John Deere at 22 forward P, or Caterpillar, or Apple? And I got to say, if you're looking at it from that perspective, gosh, it's hard not to own Apple versus those stocks. Not that those other companies are bad companies. It's just who's going to give you more bang for your buck over the years? Especially with Apple with their cash balance and now what they're making off treasuries likely. Ooh, baby. Hope you guys enjoyed today's video. As always, I appreciate every single person for joining me. And also, make sure you check out the workshop I put together last night for you guys on scaling to 6 figures and beyond in your portfolio. That will be pinned comment, and have a great day.